struggling to find follow through. It's not like they're falling off a cliff or anything like this, but as we were talking about this yesterday, we of course raised the natural question about sentiment and the makings of the rally that started us off this week. And maybe, just maybe, some of those concerns are starting to materialize. So let's take a look at the price action here today. Now, of course, it was Veterans Day, so the bond market was shuttered. When you see these performance numbers for the 10-year and the 2-year, these are the futures, and not surprisingly, it is soggy going because the actual underlying market was closed for Veterans Day, and perhaps maybe that robbed the rest of the market of a clear directional lead as well. But you do see some interesting tidbits here. S&P and NASDAQ kind of a hodgepodge. S&P up a little bit, about 0.3%. NASDAQ down almost 0.2%. Again, the bond markets are kind of a mess, but you do get a little bit of a bounce at the long end. So the 10-year future indicating a pullback in yields. Gold ultimately resolves higher by a hair, but no follow through on yesterday's epic surge. The dollar kind of a mixed bag, not really going very far this way or that. But Bitcoin, as a sort of indicator of speculative appetite, seems to be pointing toward that appetite diminishing. It is off 3%, a little bit more, suggesting that something is not quite lining up. Now, yesterday, of course, was this explosive showing. S&P and NASDAQ with very impressive gains, best performance on a single day since May. Rates up across the board as bonds come off and generally risk on trade. Gold surges almost 3%, and that despite higher yields, and as we can see here, a relatively even-keeled U.S. dollar. It's up a little bit against the yen, flat against the euro, was down a little bit against the Aussie, which we don't see here because the Aussie tends to benefit when stocks go up. It's a kind of go-to risk-on reflection in currency markets. So the dollar ultimately, in its sort of more evenly balanced expressions, like against the euro, basically doesn't go anywhere. So that gold surge outside of higher yields and outside of a dollar that didn't by any means give gold a downward push of substance, that seems to suggest that there was a sort of re-engaging of speculative narratives for the year, and a sort of re-engaging of where speculative appetite has gone this year. Of course, aside from the famously aggressive stocks rally this year, thanks to AI-linked optimism, gold has been on a famously aggressive rally around this increasing tension between the U.S. and China, and a desire for a sort of go-between asset for third countries, it would seem, to navigate without exposure to this sphere of influence or that. Obviously, we have examples of countries like Russia, for example, that are now locked into China's sphere of influence, in the sense that they do most of their business with China. Most of their monetary transactions are settled in yuan because most of what they are able to do around sanctions relief economic activity-wise is with China. So you see a clear example of a country that's now locked into sort of that world, while most of the world still is primarily transacting in dollars. So you have this sort of situation as a running story this year, and it seems like the return of risk appetite encouraged people to re-engage with a whole host of speculative narratives, gold among them. But of course, again, what we get from Bitcoin is a clear sort of sentiment nod. It ultimately doesn't perform as well as you might expect, only a little bit better than the NASDAQ. Usually you might expect Bitcoin to be much more robust in its performance. And indeed, when you looked at it on the downside last week, you saw that sort of thing. Last week, of course, was famously negative around the idea that the Fed might be stingy about this December rate cut. When we look at what the markets have been doing, in fact, since the October 29th Fed policy announcement, they've shrugged off solid earnings. As we looked at yesterday, the S&P 500 for the third quarter, averaging earnings growth of 13%. And if we look at tech, the obvious high flyer, the number there is more than double at over 27% year-on-year earnings growth. So clearly there was every reason for the market to go, AI supernova, la-di-da. They didn't do that since October 29th. And of course, we also had a very helpful meeting between Donald Trump and Xi Jinping, where they walked back the most recent attempt at escalating the conflict between the top two global economies. That didn't help either. And if we look at the chart of the S&P here, we can very clearly see that what has really energized this market at the start of this week, as we just saw, was news that this government shutdown might well be ending. Here's the Fed right here. This is the top. All through this, we had the story about the U.S. and China. In fact, this was the gap where it became clear that the U.S. and China were going to walk back the latest round of acrimony right here. Then you get the Fed. Earnings don't help because post-Fed, this just keeps marching relentlessly lower. You get an upside gap this week with this government shutdown ending sort of optimism. And today, we stall. Now, maybe we stall because of the bond market is closed and we don't get a lead from rates because, again, this was about rates. This was about Fed Chair Powell coming out and saying, look, you're probably not going to like this, but if you thought that it is a foregone conclusion that there's going to be a rate cut in December, let me tell you, not only isn't it a foregone conclusion, but far from it. And so with that in mind, you end up in a situation where the markets go from almost a 90% chance that you are going to have some sort of further easing, and you end up at where we stand currently. Here's the probabilities for the December 10th policy meeting. We can see that as of a month ago, we were well north of 90% chance of a cut. As of a week ago, which of course gives us the reference point beyond the Fed policy announcement. You can see that's already the 4th of November after the 29th when the Fed makes the news. We have down to around 60-odd percent, and we've hovered there since. Whereas the likelihood of standstill is non-negligible, hovering just below 60 or below 40% rather. The news flow that we got on this front today is not the most influential, but somewhat interesting. And we begin with comments from San Francisco Fed President Mary Daly. She spoke in an interview, and you can see the comments here are loosely dovish flavored. The balance of risks has shifted as the labor market has softened. We know that's been the Fed's tried and true song here since mid-September. Restrictive policy is putting downward pressure on inflation. Inflation expectations are well anchored. We don't want to make a mistake of holding on to rates too long, she says. If we unpack inflation data, we don't see inflation rising in services, housing, or inflation expectations. So one might say that perhaps in a familiar sort of way for Mary Daly, she's erring on the side of easing. And indeed, again, as we just saw, the markets themselves are erring on the side of easing. We're looking at a situation where the rate cut in December is still likelier than not. So the odds are better than even at 60 odd percent. But clearly the market has seen some indigestion around the possibility that maybe that won't actually occur. And with that in mind, the sort of forceful positive reaction that we saw at the start of the week kind of begs the question. Because, needless to say, this was this kind of very committed negativity, even in the face of AI optimism around these earnings reports that we've seen so far. And it was really around the Fed maybe backing away from building on more stimulus, at least in the near term. When we got this rally at the start of the week with the maybe end of the government shutdown, ostensibly the Senate has reached a deal to do that, and the markets started to sniff it out already in late Friday price action. That's how we got this recovery from this extended wick lower that we see, and ultimately ended a little changed, and then that's how we get the gap. But what we also find is that as a consequence, here's yesterday's expectations, they went down. Because, of course, if you remove an important fiscal headwind, well, then maybe you don't need to cut as much. Markets clearly did not have a problem with that, but the question, as ever, is, okay, so you get a piece of data or a piece of news that gives you a knee-jerk reaction, in this case positive, but certainly could be negative, depending on what the news is, but then it doesn't last beyond the day, because once the dust settles, everybody kind of comes back to where they were before, which is to say, if what we're worried about is some sort of situation where the Fed doesn't deliver in December, and if that's enough of a concern that tech earnings don't help to shift the balance in sentiment, well then, is it really sensible that you get a lasting rally in an environment where what the news has done is actually made that cut less likely to some extent? And so what we see then is the markets stall. And the rally does not continue to carry forward, even though the probability that this shutdown is going to end hasn't been at all diminished in the past 24 hours. So what this starts to look like is perhaps not dissimilar from what we saw with the Fed, where we get the rate cut that the markets wanted. We already had strong expectations for tech earnings. We already had the Trump and Xi news basically off the table once Bessent had those meetings in Malaysia and essentially pre-announced that Trump and Xi would have a cordial sit-down. And so the markets were priced for perfection. So when the Fed came out and said, well, actually, the one little bit in your rosy narrative here, the inevitability of a December cut, that's not inevitable, the markets went, oh, well, if we were already priced for perfection and the world isn't as perfect as we priced, we got to go the other way. So now we have the shutdown off the table, and the question becomes, well, are you again priced for perfection? Except for the Fed. And ostensibly the answer is, well, yeah, it looks like that. So if this is what's going on, and the shutdown ending actually reduces scope for Fed easing, at least in a hurry, well then perhaps this situation isn't as ripe for upside follow-through as it seemed when the markets were forcefully rising yesterday. So where do we go from here? Well, from a data perspective, we still don't have much on the calendar. We are looking at maybe inflation data comes out on Thursday. We're due for the October report. Obviously, the September one was released by special dispensation. On Friday, we might get September and October PPI. We might get September and October retail sales, depending on whether the Census Bureau and the BLS. Census Bureau produces the retail sales report. BOS produces PPI and CPI. Whether they can be corralled back to work fast enough to get these things out in a timely way. Whether that happens or not, who knows? And so we might get some economic data. We might not. Earlier today, we got the weekly report on employment from ADP, automatic data processing. Obviously, we don't have official U.S. labor market data, so this is what we have to contend with. They reported that the U.S. economy shed 11.25 thousand jobs in the 4 weeks to October 25th. So we're looking at a situation here ostensibly where, at least preliminarily, there is some reinforcement of the Fed's narrative that indeed the softening labor market demands their action. But the prior week, the 4 weeks prior to October 11th, there was a rise of 14.25 thousand jobs. So if anything, we're net up 3,000 jobs over the past data window that this has been reported, which is, of course, this week and last week. The ADP numbers started to come out because the official figures are off the books, so they started to publish not just monthly, but weekly data too. So, not much insight there, but we are going to have a busy calendar of Fed speakers. Tomorrow we get Williams, Paulson, Waller, Bostic, Mirren. Mirren, of course, we know has never met a rate cut he hasn't liked, so probably no big surprise there. We'll see where Waller is. He was dovish over the summer and has kind of pumped his brakes a little bit. Williams, Bostic, typically near the middle consensus view of the committee, so that should be interesting to look at. Paulson, too. Thursday, we have Hammock. She's very hawkish. She's the anti-Mirren, if you will. And then Schmidt, Logan, and Bostic again on Friday. So lots of Fed speak. We'll see how that informs this narrative. The latest data that we have, of course, is the ISM survey that we got last week that ended up with weaker than expected manufacturing. As ever, 50 is neutral here. Above 50 is growth. Below 50, contraction. The further you go in each direction, either the further you go above or below, the faster that pace. So the further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. So we got faster than expected growth in services, but also faster than expected contraction in manufacturing. That probably evens out to something like slow growth overall and a bit faster in October than September because the service sector is a bigger part of the overall economy. But all of the issues that the Fed is balancing here were on full display. Employment in contraction mode for several months now, and again in October, across both services and manufacturing. The price structure, annoyingly elevated still. In the case of manufacturing, not surprisingly, prices are coming down because demand is shrinking, as we just saw. Services, where it isn't shrinking, prices are still near their peak highs of the cycle. And that, of course, continues to keep the Fed in this sort of tightrope walk where they're trying not to let inflation back out of the bag while dealing with what's going on the labor side of things to the extent that they can. Because, of course, they're trying to cut rates to spur hiring, or at least to backstop the labor market that appears to be shedding. But it's unclear whether they can do that because it's unclear what sort of impetus rate cuts can give if employment is being primarily held at bay, or at least employment growth, by immigration policy, which has reduced supply, and by AI, which has improved efficiency. So it's unclear to what extent you might get companies, even though AI maybe has not improved efficiency for the majority of firms near term, they're certainly looking ahead to saying, well, how much efficiency might we be able to glean downwind? Let's not staff out everything under the sun now. Let's see. So to the extent that the tariffs have created uncertainty and AI has created uncertainty for companies to build labor forces, and to the extent that immigration has slashed the supply of labor, you end up in this sort of environment that the Fed has been scratching its head around for a while now, where you don't have very much firing, but you also don't have very much hiring. And maybe the firing is starting to pick up because, of course, just last week we got those challenger job cuts numbers, which showed companies are intending to cut significantly at this point. So perhaps we're finally getting to the place where the Fed's calculus is going to tip in a direction, but so far they appear to be stuck and going very slowly. The markets still expect a lot more easing out of them next year than they have owned up to. We have 67 basis points, so now a better than 50-50 chance of 3 cuts, 2 cuts already baked in, but of course the Fed has only owned up to 1. So even if the Fed were to do something moderately dovish with this commentary this week, the question is, well, how much more dovish are you going to get? The markets are already well ahead of where the Fed is just past the December meeting. So an interesting sort of setup here. We can see since we had this latest cut, this was, of course, that meeting where Powell said the scary things that the markets didn't like. Stocks topped and haven't attempted to scale the highs. The dollar has pulled back at the start of this week a bit, but still continues to be on a trend higher, despite, as we can see, the actual start of rate cuts. So that trend remains intact. Now, if we get economic data this week, we'll see how it performs. Recent data from Citigroup suggests it's tended to be better than expected for the most part, and the Atlanta Fed GDP Now model is telling us that most data going into the model has been relatively positive for GDP growth. But so far, we don't know, first of all, if we're going to get this data, and secondly, we don't know if the markets are going to like it, if it diminishes the probability that we get this December cut with economic strength on display. So if nothing else, what we find in today's price action is that after a day of exuberant cheering for the end of the government shutdown, maybe, likely, let's say, momentum has been sapped. And we're going to try to find out if we're going to get it, but if we don't get it rebuilt tomorrow when we return to an active bond market, well, then perhaps sentiment really did have only one day in it and we're back to defensive mode. Now, as far as positioning is concerned, I'm a little bit long gold at this point, which I flipped over at the start of the week once it rallied. Still long the dollar, very short the pound and the euro, though late last week, I cleaned up the trade on the Canadian dollar, took profits there. At the start of this week, took profits on the Aussie short, and have a little bit of a smaller exposure. On the spot side, I'm still short yen as well. That's been working. Still short a bit of risk through IBIT, the Bitcoin ETF. That's been working. That's down over 3% today. And long a little bit more on the metal side with a call vertical on SLV, looking for silver to keep going higher. Short risk through SPY, basically off that Fed high. That's obviously somewhat under assault here, but interestingly, because the trade was from those Fed highs, it's still narrowly in profit. So we'll see if that's able to be sustained. Long the bonds, that seems to be working better today. while we're shuttered. We'll see if it still does tomorrow. And crude oil still a little bit short there, despite a bounce today. We'll see if that bounce ultimately finds follow through. So we might have to unravel this one, but we'll see. It hasn't crossed any Rubicons yet. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. Also writing for the news and insights portion of tastylive.com and commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching this on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.
Stocks meander. We'll go with that. It's Tuesday, November 11th, 2025. This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco, Dylan Radigan in Milan to take you through the next 30 minutes as we wrap up. Well, futures trading day closes at 5 p.m., so Ilya will take the handoff into the close. It was a unremarkable day. Stocks continue to sag on the tech side as investors question whether or not AI is overvalued. But the money's not leaving the equity market. S&P 500 up. The Dow Jones up even more into what is a new all-time closing high here. Russell adds a little bit as well. Bonds with the market close for Veterans Day, we do see ultimately a slight push higher. Fed rate cut odds jump a little bit after that ADP weekly report showing the economy shed nearly 12,000 jobs in the 4 weeks ended October 25th. Gold and silver, well, silver's able to push higher and gold climbs off of its lows. Energy has a firm day and the dollar mixed, if not slightly lower. Guys, we're running out of time here on Overtime, so let's get through this quickly. Dylan, AI was knocked a bit lower today, but the broader equity market's still holding up. The S&P 500, 6871 and a half here after hours. Nothing to be concerned about, even though we see headlines like SoftBank's Massason is selling his entire stake in NVIDIA.
I mean, you can't have it both. You can't. I'll answer your last comment first. You cannot have it both ways and look at SoftBank and Massa as an idiot who got bamboozled by WeWork and all the other things, and all of a sudden he's a genius because he's selling the NVIDIA. My perception of that NVIDIA sale was really having less to do with NVIDIA and more to do with the all-in position on OpenAI. It sounds like they're sort of like, it's like they're digging through their pockets looking for extra change to try to fund their OpenAI position. And so that's kind of how I see that. As far as the overall market, I mean, this is sort of market back in the Bloomberg days. The headline would be, stocks, hover on records amid, limited price action. I mean, it's kind of one of those days where but you can't really be too dismissive of it because look at the levels. You are dancing at or near all-time highs. I think what becomes interesting, and I, not to be a broken record, I don't think you were in this conversation last week. I think it was right before you came back, but just sort of the idea of rotating into the worst performer of the Mag 7 as a trading hypothesis. And I got lucky with that, sort of pressing that through Amazon. And I've been pressing it back through Microsoft and Meta, obviously. And so I just think that is a very reliable, I think you're in a much better position to be getting long a Mag 7 underperformer than trying to time any major sell-off or anything like that. And I see no reason for concern other than the obvious reasons for concern, which is the price levels and incredible optimism that is almost impossible to justify. But that ship sailed, 2 years ago.
Oh, yeah. I saw a really fascinating stat today. Every year since 2013, if you look at the start of the year, January 1st, Goldman Sachs says their basket of most shorted stocks. And every year since the start of 2013, that most shorted basket has outperformed the S&P 500 every year. And that's going to be the case again this year.
Can we get an ETF securitized? I mean, at this point.
Just a basket of crap.
Yeah, just Goldman's ye old Goldman's basket of unloved stocks.
What are we making this today? I mean, I have to agree with Dylan there. I was looking through the headlines about SoftBank, and they already are 21% funder of OpenAI. It seems like they're
Hmm.
just trying to, I don't want to say get away from the space, but they're taking their winnings from NVIDIA and they're dumping it now into other AI opportunities that will be
Hmm.
more application facing. Isn't that a good sign ultimately that this is, we're trying to go beyond picks and shovels, which is what this really has been the entire time thus far?
I mean, the problem with picks and shovels and all of this would-be rotation is the thing that one Michael Burry has been warning about, and you increasingly are starting to see these things appear in other conversation, basically saying that you really should be listening to what Mike Burry is saying. He's not saying that the technology is bunk or that the thing is somehow wrong or bad or not plausible as a narrative. What he's saying is nobody's paying attention to one tiny little tidbit that makes this different from railroads, from telecoms, and that's depreciation. These GPUs obviously are the biggest kind of engine of what this thing needs to be what it is, and they depreciate in 4 to 5 years. Railroads don't. Telecom lines don't. And so the kind of spending that we see here to ramp this thing up, it isn't a one-off like a picks and shovels in those, like a picks and shovels phase in those things would look like. This is not one of those things where you build the thing and then you rotate to demand. And since you've upfronted all of your capital expenditure, your capex is out, now you're just minting money. But that's not what's going to happen here, and that's not the nature of this thing. The level of output in money to get all of this stuff up and running has to be spent, then respent, then respent, then respent, then respent, because these things depreciate very quickly. And so the amount of money that you need to keep this thing running is astronomical. Not surprisingly, a lot of that money has increasingly started to come from non-bank credit. We spoke while you were away with Dylan about how much we should be worried about non-bank credit. Because when you look at what the market seems to be sniffing out, just take a look at BX shares, take a look at APO, take a look at KKR, just as avatars. And take a look at what they've been doing really all year long. So the market is not blind to the idea that there is something in this space that maybe smells untoward hiding under the rug. And so, yes, of course, there are these efforts at rotation. Yes, of course, there are every which opportunity to get money and deploy it while the getting is good. And the getting is good, there's no question. Nothing has collapsed. But when we talk about rotation, I think we have to remember it's not clean, because what we have now is an incredible expansion of credit, an incredible demand for money, and I should say non-bank credit. So all of those things that we told the banks they couldn't do after '08, it's not about the banks. This is about non-bank credit. They weren't told anything. And so we have a situation where we have this huge expansion of credit. The market is freaking out about a single Fed rate cut in December up until they get the shutdown news yesterday. And lo and behold, it's been 24 hours. The market has stalled. And the shutdown end isn't even official yet. So they got their headline, they priced it in, and where are we? Back to worrying about rates, ostensibly. Because the follow-through, again, is where? I don't know, but it's not in the NASDAQ today. So if all of this hopium is real, if this rotation is real, if the thing is expanding into a glide path toward its eventual sort of maturation as an industry, markets sure aren't showing it. And the concern, again, isn't that AI isn't real or that it isn't the transformative technology that it's supposed to be. No. And in fact, things like DeepSeek might be the answer, because they have technology for this that's less power intensive, ostensibly, that's less expensive to deal with from a depreciation perspective. But lest we ignore what's going on here, this is not a clean rotation into you build the railroads, you put the railroads on the tracks, we're all rich. That's not what this is. So it's not surprising, really, that the markets are stalled today, and it's not surprising that they're still worried about rates.
The Apollo, KKR, Blackstone, those are the private credit story is really interesting to me. I don't know if there's something super actionable there at present.
I wouldn't say yet. It doesn't look like yet. I mean, if you were going to sell these things earlier in the year, then okay, good for you. You're prescient and you sold them. But I'm not trying to chase this now.
Corporate high yield bond indexes and ETFs are holding up. HYG, J, and K are both fine. You'd like to see them a little bit stronger given where stocks are, but that's really nothing to, in my opinion, in the short term to complain about.
I mean, they're kind of idling, let's say, if you kind of squint since what, July-ish?
Yeah, but
but not falling. Not
falling.
So there's no fire here.
No, there's no fire here. And we can see that there's no fire in the market today. Gold takes a little bit of a breather. Dylan, I know you're not much of a precious metals person, but it's hard to ignore the fact that these alternative measures of currency storage, perhaps, Ilya, Bitcoin, gold, silver, they're holding up again. They're starting to perk back up.
Bitcoin had a nasty drop.
Yeah, I know it wasn't a great day today for Bitcoin, but we're starting to see signs of, couldn't get through.
What a reversal at the spot where you'd want it.
Yeah, well, I mean, I was hoping to get it through there, but we never did. So nothing.
I mean, I'm still short, so hope is in the eye of the beholder.
Dylan, the government's going to reopen. It's going to stay open for 2 months. The continuing resolution funds the government through January 2026. So it's not like this story's over and done with yet. Do we keep betting against the competency of the federal government in its current iteration?
I think you do. I mean, I think that's the surest bet that exists. I think it's not even a bet. I mean, I think it's a certainty. I think it's a foregone conclusion that the government is fundamentally conflicted, self-serving, narrow-minded, and incompetent. I think that the question is the degree to which that reality, how that plays out. I mean, the unfortunate, I'm being somewhat demure, but the unfortunate thing with this most recent shutdown is obviously all the human lives, that all the people that lost, or all the economic stress that comes from it. I guess I'll put it that way. But I mean, I just think that the air traffic control thing was just really disastrous. I believe that when the midterms come next year, however unappealing the Democrats are or will be, that the situation with the air traffic controllers going into the holidays this past month is going to be a signature piece that's going to be impossible for the Republicans of the Trump administration to get away from. But what I don't know is how does this actually play out in the financial markets, if at all? I'm more intrigued by what's going to happen with the Supreme Court and the tariffs. Because I mean, that seems like it could actually be something. Just because it's sort of the peanut gallery seems to think that there's a reasonable chance that the Supreme Court's is going to rule against the president's authority to unilaterally levy all these tariffs.
Yeah, Trump came out and said that the Supreme Court was given the wrong numbers.
The dog ate my homework.
So the Trump administration's lawyer had the wrong numbers when arguing in front of the justices here. Quote, the unwind in the event of a negative decision on tariffs would be including investments made to be made and return of funds in excess of $3 trillion. It would not be possible to ever make up for that kind of drubbing. that would truly become an insurmountable national security event and devastating to the future of our country. So even though these tariffs weren't in place until earlier this year, and the country did exist for the past 248 years prior to the implementation of this particular round of tariffs in year 249, evidently this would be a non-sustainable path forward if we were to just wind back the clock to where we were. Now, granted, the tariffs are supposed to be addressing certain issues that have cropped up in the wake of globalization, but they haven't solved any of those problems because the tariffs have been in place for a number of months and manufacturing jobs are down, industrial jobs are down, exports are down, farmers are getting bailouts that they didn't need before. What's the positive upswing here? And consumer prices are up, margins for companies that are heavy export facing or import facing down substantially, which is leading to the curtailing of employment in those industries. So I'm just waiting to see what the upshot is. Well, gold's doing really well. That's about the only silver lining, golden lining I could take away from it. But Dylan, I mean,
because